Welcome back to the vlog. We are going to jump into chapter 10, which is money management plan. Yeah. All right, so we're just gonna jump right into it. It's obviously a nighttime vlog. The visual's not gonna be as great, but as long as you can hear me, that's fine. All right, day traders have the potential to make a lot of money, but oftentimes the profits associated with trading are highly correlated with the risk taken. In other words, higher returns almost always come at a cost of higher risk. Money management is the practice of limiting these risks by setting up certain constraints that must be followed. For example, a day trader may set a maximum stop loss of 5% on any individual trade, which helps limit the risk of any trade to just a 5% loss, with the exception of cases where a lack of liquidity in the market creates slippage or price gaps. These limits can help to reduce the risk of a catastrophic loss from a single trade that goes ARI in order to improve risk-adjusted returns over the long term. In many ways, the practice amounts to answering the question, how much should you risk on a given trade? There are many different possible answers to that question. When it comes to individual trades, position sizing can help determine how much capital to commit to a given position. When it comes to controlling risks associated with the trade already in progress, day traders may want to use stop loss points or other limits in order to reduce the odds of a one-off catastrophic risk impacting their portfolios. Finally, there are emotional limits that must be placed in order to prevent the day traders from losing their nerve. Money management may also be extended to include the day trader's overall financial situation beyond just trading. For instance, day traders should avoid using any form of loans to finance their business, with the exception of trading on margin. Day traders should also ensure that they have sufficient capital left over to finance their retirement savings and other personal finance accounts, in order to avoid making mistakes that could cost them in the future. Goals, bankroll, capital preservation. The first step in developing an effective money management plan is determining how much capital one should risk in the endeavor. Day traders should start by calculating how much money they can afford to commit to the business. For example, someone with only $30,000 in his bank account may want to think twice before day trading stocks, since those efforts will require a minimum of $25,000 to get started. It's usually a good idea to avoid taking on outside debt to meet the minimum requirement of day trading, given the cost of maintaining these levels of capital, which eat into the bottom line over the long term until the debt is repaired. The danger with overcoming is accumulating interest from debt and taking on unnecessary emotional stress. When a trading opportunity arises, the last thing a day trader needs is a voice in his head reminding him to worry about how to pay next month's rent. The second major consideration is how much money is needed for the effort to be worthwhile. For example, a day trader that requires at least $5,000 a month to live on and only has $25,000 to commit to the business will have a tough time making sufficient returns to sustain his lifestyle. Day traders can moderate these expectations by starting off in a part-time role, committing to trading only on certain days, or by joining a proprietary trading firm that may be willing to put up some capital for the trader to use. The third and final consideration is how much money day traders are willing to risk at any given time or on a given trade. For instance, a day trader may have $100,000 in starting capital, but may be uncomfortable losing more than 25% of his bankroll. Day traders who are comfortable risking only $25,000 may be forced to implement less risky trading systems with lower average returns in order to have lower maximum drawdown risk. The same dynamic applies when it comes to how much traders are willing to lose at once on a given trade. So, how to make a plan. Day traders should take into account all of the aforementioned factors when developing a money management strategy, in order to avoid many of the pitfalls associated with trading. For example, the amount to risk on each trade is a necessary consideration in order to plan out how many trades can be placed each day and the stop loss points for those trades. The first step is establishing how much money one will be committing to the day trade, or committing to day trading, and then using that sum to determine the maximum amount to risk per trade. By setting these limits before placing any trades, day traders can eliminate the temptation to overcommit to a losing trade that could ultimately put the entire account at risk. Margin trading comes into play in making these considerations, since traders are required to maintain a minimum balance in the account in order to avoid margin calls or other potential risks. The second step is establishing how much risk is acceptable for each trade. Day traders often choose to automatically exit positions where they lose more than a certain amount, such as 5% or 10%, by using stop loss orders. Setting these maximum expected losses ensures that traders will never be tempted to hold on to losing trades that can prove very costly and dangerous over time. Traders should try to cut losses early while letting profits run late in order to maximize their overall trading performance. The third step is to establish a strategy for ensuring the profit goals are being met and for taking money out of the business over time. While most beginners will lose money or break even during the first year or two, the long-term goal is to turn day trading into a business that generates an attractive annual salary. Consistent record keeping should help make it easier to predict how much profit will be generated each month or year. Using that data, day traders can calculate how much they can afford to take out of the market over time. Day traders should write these 3 money management rules down on paper, code them into an automated trading system, and/or ensure they are constantly aware of them and following them. Without having a well-defined set of rules, day traders run into costly problems that can quickly eat away at profits over time, or quickly implode an account in a short period of time. The most important part of establishing a money management plan is sticking to the rules consistently over time. Day traders are constantly tempted to break the rules in special circumstances, but as with the trading systems, it's more important to follow the rules than focus on the results. The rules can be changed over time to fine-tune results, since traders will then be fully aware of the consequences rather than making case-by-case decisions. Quick recap. Money management is essential to the success of any day trader's operation, since it involves both maximizing profitability and mitigating risk. Ultimately, the key question to ask is how much capital should be risked on each individual trade. The amount of profit generated over time is largely dependent on the initial bankroll and the amount of risk a day trader is willing to assume. These metrics must match up with the day trader's expectations in order for them to be successful. Capital preservation is just as important as generating profit, since money lost must be recouped in order for a profit to be made. By locking in the profits and establishing strict money management techniques, traders can effectively preserve capital. The most difficult step in establishing a trading plan is developing a trading strategy that's capable of generating consistent profit over time. Traders should carefully backtest and paper trade their strategies to ensure their durability. After developing a trading strategy, day traders should carefully document their trading performance for both tax and performance monitoring reasons. In particular, traders can quickly identify problem areas by regularly reviewing their trading performance. And lastly, day traders should write down their trading plan and automate as much as possible when it comes to strategy execution and money management. By doing so, they can avoid many of the potential issues precipitated by human emotions. All right, and that was a quick one, and that's it. Next chapter will be next chapter is just titled Trading, so we'll see. It'll be a surprise to both of us. All right, thank you for joining, and I'll see you guys next time.